Good afternoon, and thank you for joining us for today's roundtable on building private equity portfolios through bolt-ons. According to Preqin data, the number of private equity-backed bolt-on deals last year was the highest since 2006, totaling a little over 1,100 transactions globally and 738 in the U.S. alone. Now, the aggregate deal value of that was about $50 billion globally and $25.8 billion in the U.S., the largest and second largest respectively since 2006. The rise in bolt-on activity comes as private equity firms with huge amounts of dry powder to deploy are facing tough competition from strategic buyers on platform deals. I'm Tony Hill with Intralinks, and I'll be moderating today's discussion. Joining us today are Jim Anderson, co-founder and managing partner at Clearview Capital, Richard Prestegard, partner of business development at High Road Capital, and Robert Landis, partner of origination at the Riverside Company. We've got a lot to cover today, so why don't we get started? So why don't we start by taking a look at the previous year, 2014. The number of private equity-backed add-on deals was the highest since 2006, as we just mentioned. And of the 1,100 or so that were done, over 740 were here in the U.S. Now, my question is, what drove that increase? And do you expect that trend to continue throughout 2015? And Bob, I'd like to start with you.
Well, I think one of the key issues that drove that trend was the fact that multiples have been at perhaps the highest they've been in my career within banking over the past 35 years. And the only way that you can achieve a good return on your investments is to do bolt-ons at a lower multiple. So there's a real drive for us to enhance the value of our portfolio company by looking at companies that are perhaps smaller and which we would be paying a significantly lower multiple. Today, an investment banker will start out by selling you an average company you should be paying 9 times, which used to be the old 6 times. So they're actually looking north of 10 times for the platform. So we need to find add-ons at that 5, 6, 7 times that are not quite as pretty, that have huge gaps in their management or huge gaps in their sales organization, but they have a great product or a great service that fits perfectly. So that's what's driving it.
And you'd say this is an industry-wide phenomenon right now?
Every industry that we've looked at, we have 8 basic industries that we chase, and we've seen it right across the board. But again, add-ons are part of our strategy. Last year we bought 40 companies, 20 were add-ons.
Interesting.
Yeah, and I would just say, just to add to that, that comment fits to at all different levels of the spectrum in terms of size. It's all relative. You know, we focus on a deal size range that's in the $3 to $10 million of EBITDA range. Bob's platform kind of spans the gamut of the middle markets, and you guys are a little bit more.
We're about same size you are.
About the same size. So it's all relative. You know, platforms for us are also higher valuations right now than probably we've ever seen historically speaking. So the inclination is to lower that overall valuation that you're in on the investment by doing add-ons.
Okay. All right, well, let's change gears a little bit, and let's talk about some of the considerations and challenges you guys face when you're actually doing bolt-on deals. So I have a 3-part question coming your way, and I want to start with, on average, how many bolt-on deals do you guys do per platform company? What are the key considerations you look at when doing one? And part 3, what are the challenges? So can we start with you, Jim?
Sure. I mean, every portfolio company is different. So we have certainly had circumstances where we have companies that are really just great organic growers and we didn't do add-ons. But typically, we have the same situation everyone has where the platform is very expensive and it helps a lot to bring that average multiple down by doing add-ons. So I would say in situations where we are pursuing add-ons, it's typically 3 to 5, but we've done as many as 14 in one platform. It can be difficult to do them. You got to make sure that you have a management team that's on the same wavelength that you are, and believes in this way of adding value. And for us, we found really the key consideration and the place where you can fall down is having a really good IT backbone that allows you easily to grab control of that add-on acquisition and bring it in so you can measure the right things and integrate it into your IT system. That's always a challenge. But that's why when we start with our investments, we always make sure that we've built out a good IT backbone and have ourselves on the same wavelength as management.
Can you give me a quick example of what you mean by IT backbone?
Sure. So, when you buy a new company, typically a smaller one, if you're going to buy it at a lower multiple, isn't a perfect company. So they very often have a bookkeeper, not a controller. They might not measure the same kind of metrics that we believe need to be measured. And so to be able to do that and grab hold of a company and measure something that might be, for example, 1,000 miles away, you need to be able to have an IT system that plugs in very easily so that you can integrate all the things that they're supposed to measure into your central system.
Got it. Rich, anything you want to add on the considerations, challenges, number of
Yeah,
add-ons
sure.
per platform?
Sure, I would just say that we typically are evaluating add-ons in a very similar way that we evaluate platforms, and you want to add to your platform another good business, but it's the obvious differences fit, and it starts with the management team and what's happening with the management team. Are they staying? Are they going? But how the management team fits is one of the strongest considerations that we have to have when we're looking at add-ons.
Yeah, for us, and we've done 385 deals since we were founded in 1988, and about a year and a half ago, we took a look back empirically and looked at all of the results from our exits on all of these companies. And we found that for every company that we did an add-on within the first year of acquisition, and it could have been the back end of that, but within the first year of acquisition, we got 1 to 1.5 times EBITDA more for those companies than those which we didn't do add-ons that first year, but it became a little bit later. Doing an add-on is a very uncomfortable situation, particularly for a CEO that's sort of built his company, he or she, and have never had that strenuous integration process, bringing in new people, bringing in new sales, new organization, to go to Jim's point about IT. Once they've gotten comfortable that the first time, they sort of get hooked on it and say, it opens a whole new horizon for them. So our job on the origination is to bring add-ons immediately once we buy the company. They don't necessarily have to jump on them right away, but they see that there is a market outside of just doing the same old growing organically. Some of our companies we never did an add-on, but almost all of them, to go to Jim's point, we've done 2 or 3, and the best companies we've done 5 or 6.
So the sooner they move up the learning curve, the more accustomed they get to doing add-ons, the faster and more efficient, I suppose, it is to do more.
I think so. One other consideration, of course, is do you have the capacity? We bought a couple companies. One was a spin-off from Johnson Diversity Du Bois. They had something like 60% capacity. So that was a constraint on add-ons, because every add-on that you looked at, the first thought was, how do we integrate it and move that production to this facility? And that was key. So some of the add-ons, they were not willing to go that route because they didn't want to uproot all their employees. Others, you were very upfront in saying, we're willing to provide relocation, but we need to fill up that capacity. So there were cost savings and synergy involved, but that sort of restricted your whole philosophy of doing add-ons. Others, it was all about management. Can these people work together? Some of the ideal situations are where the add-on to people who run that company say, this is my last swan song. I'm going to sell the company and I'm retiring. And you go, yahoo, because you don't have to worry about that management integration. A couple other times we did add-ons, and the CEO was so good that CEO wound up becoming the CEO of the entire company.
We've taken a little bit different approach on several occasions where we were in trying to avoid paying a very high multiple for the initial platform. We've bought some businesses that were good businesses but not perfect, and that we felt required at least a year of development, if you will, making sure their IT system was ready, upgrading from a controller to a real CFO, adding 1 or 2 people, and getting that company really ready to pursue add-ons. And over that period of time, we'll also do a really in-depth segmentation of the entire industry so that we can be really clear about what we want to acquire and then go out and find them. And I agree, we tend to show things right away, but we're a little slower typically to pull the trigger. We have some situations where we bought an absolutely great company out of the box where that's not an issue, but a lot of times it takes a little while to make sure that platform company is really ready to do it successfully. So I would say we're typically probably slower to start and then accelerate toward the end.
Okay, so.
Yeah, I was just going to say from High Road's perspective, we're probably maybe a little bit in the middle. We want to hopefully have a platform that is ready to go out of the gate. That's not always going to be the case, and some platforms have more work to do in the back office and in the systems and other things before you can go ahead and do an add-on execution. But we also know that when you make the announcement for investing in a new platform, that's probably when you're going to see the most inbound activity and deal flow / idea flow on, okay, banker here, banker there, banker, bankers across the country are going to see that you just did a new platform. They want to bring you value with their thoughts on who you should buy as add-ons. So that discussion starts during the due diligence process. Who are the targets, and who do we want to proactively go after? And let's think about how we're going to react when the deal flow comes in.
Makes a lot of sense. You announce a platform acquisition, bankers, advisors, they see that, they're going to start reaching out to you with opportunities. Jim, is it tempting to move on some of these, or do you guys stick to your guns and sit out through that incubation period?
Like I said, it depends on the company. We've bought some companies that were absolutely acquisition ready, and we've gone right away, but there's some others where for example, we just didn't think we had the financial function in place to do it. You can really hurt yourself, and which is why we also our add-ons are typically very small. We're more likely to do a lot of really small ones than like-sized acquisitions. We've done it a couple times, and actually it's been successful, but you take a lot more risk when you do a big add-on acquisition, because if you're wrong, you're dead. But if you're wrong in a small one, you can recover. And I think that's why we've been able to manage our loss ratios, so we've only ever had one loss out of 23 platforms, which is really, and that's part of the reason, because we're very cautious in how we approach it.
Think about it. You're talking about the entrance side, but on the exit side, sometimes you see some really beautiful add-ons, but you're getting ready for a sale process, and then you have to say, do I hold off exiting now? Because the integration is going to take another year, and that just prolongs a longer cycle, and you can add a lot of value, or you're at risk of really mucking up the system, and it's not a 1-year wait, now it's a 2 or 3 for that integration.
Or do you decide that you're going to essentially tee it up and show the next buyer there's a lot of value here for you to get, and then you get some of that value in a higher multiple potentially. It's hard to know, but.
Well, continuing down that same vein, let's talk about integration. So deal announcements, add-on deals, platforms, and the like, they get all the fanfare, they get all the attention in the press. But one of the sides of private equity that you tend to hear less about in the press is the integration side. So, I guess, Jim, my question to you is, what are the prerequisites for a speedy and effective integration?
Well, as I said before, having an IT backbone that allows you to fold that company in is really very important. It also helps. There are lots of different kinds of add-ons. We have one company, our Senior Care Centers of America company, where we've done 14 add-on acquisitions, but essentially all our targets did exactly what we did. They were adult daycare centers, so we knew exactly how to operate them, and they were very easy to fold in. But there are other circumstances where you're buying a company where you say, gee, we don't do this, but it's complementary. Those are a lot more difficult, because you typically are going to need more management from that acquired business. And then you have the possibility of a clash of management, or a person who's always run his own show now becoming a member of a team. These are the things where we like to joke around the office that a big part of what we do is we're psychologists. Because you're managing people and keeping them happy while trying to maximize the potential of the business, and it's a juggling act. So when things fall down, it's typically about people.
That's an analogy you hear a lot on the advisory side as well, by the way, right? Being a psychologist in addition to being a banker. On the management front, Bob, can you talk a little bit to some of the challenges that you have to deal with during integration between the management / ownership of the original platform and the new management teams being brought in through these add-on acquisitions?
Right. I mean, it's a communication issue. As you're going through the process, as the private equity firm Riverside are talking to the add-on, as well as the platform CEO and their manager talking to the add-on, you want to make certain the message is constantly the same and consistent, and it's aligned, because you want to manage the expectations of that add-on being brought in. The worst can happen is that you don't provide the right information, people get nervous, and people vote with their feet. And typically, the people who vote with their feet are the best ones. Those who can't find a new job don't vote at all.
That's right.
So you're trying to, one, manage internally, and then you've got the external market. Oh, the company's for sale. They're being integrated. The salespeople aren't going to be there. So their customers get nervous. So it's a continual message externally to the outside market, to where you get your revenue, as well as internally to keep the people. And then you've got the IT issues. You've got is there going to be a plant relocation? If there is, you got to let the people know ahead of time. And this is your package if you decide not to go, so that people don't basically shut down. Either they shut down with their feet and leave, or they just sort of shut down and out of paralysis. So I think that's huge. But you have to look at all the systems, the IT systems, the sales, marketing, distribution. The ideal situation, as I said, is when most of the management doesn't want to come, and you can take all the customers and integrate it if you have the excess capacity.
Let's talk for a minute about the infamous 100-day plan. Okay. Can you tell me the difference between the 100-day plan for a platform acquisition versus that of a bolt-on? And a part B to that question is, once everything's integrated, how do you measure the success at the end of the day of a bolt-on deal? Rich, you want to kick us off?
Yeah, well, I mean, I'm focused on deal sourcing and bringing in the deals. So, you know, as far as technically the differences between our 100-day plan on a platform and a 100-day plan on an add-on, I'm probably not the right person to speak to that, and I'll let my colleagues speak to that. In terms of what, you know, measures success, it's just, you know, at the end of the day, are you building a bigger and qualitatively better company? And you don't really know that until exit. But you know, you should be doing the add-on because you are generating a better IRR. You're going to generate a better exit multiple, and you really, in my opinion, you won't really know that until you exit. But I'll let you guys talk to the 100-day plan issue.
Yeah, I look at it two ways. The first 100-day plan is the platform, and if you get that right, everything else will fit. Because when we go into a company, we say part of our strategy is doing add-ons. And you need to get comfortable with that. Obviously, if there's so much organic growth, as Jim had mentioned, then we put that to the side. So you've got your 100-day plan of your platform, and that starts oftentimes even before we close, because we're laying out those things. So on the day of the announcement to the outside world, we're ready to go, and we've already started implementing. And the 100-day plan, it basically means that 100 days, you sit down and say, where are we in our plan? Because it's a continually evolving plan. And part of it is the add-on strategy, where people like myself and Rich will come in, meet the CEO and say, what is your strategy for add-ons? And if you don't have one, that's not good. You may have a strategy that says, we're not going to do add-ons because we have so much organic growth right now, or we have to fix things before we start looking, but keep showing them to me. Then you've got also outside forces like a company called Sutton Place Strategies, Nadeem Malik, who's out there telling the LPs, I've got this great statistic that I can provide you how good a PE firm is. So the limiters are now saying, what's your add-on strategy? And then what's your strategy for this? So they're asking those same questions as well. So you need to have that. But when the new company comes in, that's kind of getting on board, adjusting for their needs, adjusting for their strategies. And sometimes the add-on you bring is in a different vertical, adjacent but a different vertical. So now you've got two add-on strategies. You've got continue the add-on strategy for the platform, plus the add-on strategy that will fit with the add-on.
Jim, anything you want to add?
Not really. I think the platform is a little bit different. We typically have a lot of things that we want to get to, 5 to 7 really big themes that we think are going to carry through the investment. And as I said, because we're doing relatively small add-ons, typically we're folding them in. So it's a different approach, or different things you have to worry about, because we typically don't need to keep management of the small add-ons that we're folding in.
Got it. All right, we're going to change gears and talk a little bit about the current M&A landscape, the competitive environment. Before we get started, I just want to issue a quick reminder to the audience that if you'd like to ask any questions, you can do so right through the computer screen, and if we have time for them at the end of the segment, we will be getting to those. So anyhow, going back to the subject at hand, the current M&A environment, how would you characterize it? And more importantly, how does it compare to this time last year? Given the fact that we've all heard about 2014 being the best year we've had on the books for several years now. What are you guys seeing out there, and how does it compare to last year?
They may differ in my opinion here, but I'm not sure it's that different from last year. It was hot last year too. Is it a little hotter? Yeah, I mean, maybe it's a little hotter, but it's just shades of getting your hand burned when you touch things, I think. Multiples are very high. My opinion is they're going to stay high for a while. I just think the world's awash in liquidity, and with money floating all over the place, it's natural that assets get bid up. I just think it's going to be like that for a while, because while the Fed may raise rates in the short term, they're not going to raise them much. They really can't do it. So look, it's hot. I don't think it's really a lot more complicated than that.
Yeah, I generally agree with that. The statistics bear it out too in terms of deals closing in the first quarter that you see in the various published sources. But we also, or at least I am specifically focused on what's before that, which is finding the new deals. And I do think the first quarter was not that different from first quarter of last year. In my eyes, it was a little bit off. Just looking at our statistics, our new books coming in were a little bit lower. But really what I thought the issue was in the first quarter, and again, these guys might have a different opinion on this, but the quality I thought was off more than the volume. And that shows in how many indications of interest would get submitted. And just talking to other people in the industry, it seems, volumes were flat to a little bit down, but indications of interest on new deals, again, for us, were down by more, quarter to 30% in the first quarter.
If I could interject on that just one moment, could you define what quality means to you guys?
Well, you can measure quality in a lot of different ways. In this instance, I'm talking about, us deciding that we want to submit an indication of interest and take the next step. And if we're not doing that more than we did in the first quarter, then it's because we're not seeing deals that we think are quality enough to want to own. The volumes, like I said, were down a little, and then when indications are down by more than that, that's an indicator that maybe you're seeing a little bit lower quality deal flow.
Okay.
Yeah, for us, and I have 3 different funds in North America, so it's a little bit different. One is a minority, one is what we call a microcap, which is companies 1 to 7 million EBITDA, and then our large cap, which is 7 to 25. In the smaller microcap fund, I saw a significant pickup in January and February, started to trail off. In the larger one, very strong in January, which I was shocked. I mean, usually in January and February, we're picking up our phone to see if it works. And it was starting to ring around the 10th of January. The number of deals that we started to chase, though, that strategy has changed. And it changed as of 2014. With multiples so high, you can't chase the run-of-the-mill deal and pay 12, 13 times. So we've started to look a little bit differently and focus. So to go to Rich's point, we didn't submit as many bids. We submitted bids where we looked at deals and said, not as lovable as some of the others, but it's got a fixable flaw and we have an advantage that we think we can do something with. Or those that were just outstanding companies. Do we really want to do it? Are we going to commit? And do we have something that we can add that makes it unique? Paying 13, 14 just to put a deal on your books isn't going to make your limiteds very happy in 5 or 7 years. We have to figure out what can we do. And for those people that are modeling correctly, and everybody I've been talking to, they're modeling an exit to 1 to 1.5 times less than the entrance. And I don't even know if that's enough, but it certainly is the right way to do it, because trees don't grow to the sky, and these are not going to stay here forever at these levels. So you have to have a more realistic exit number, and then what can I do to still get a good return for my limiteds?
Okay, so looking at deals that aren't 100% polished, there's room for improvement, there's room for growth. You can leverage your own core competencies and team to get that better deal, not pay that massive valuation. Now, on that subject, with this environment of high valuations, what role are strategics playing in all of this? How are you guys navigating deals with strategics out there who presumably are willing to go and pay these higher valuations? What does that mean for the private equity side?
Well, I think, at least for us, I don't know that we have had that many circumstances for the size companies that we pursue where we were competing with strategics out of the box. It happens sometimes, but most of the time I think we're still competing with private equity for the, call it $4 to $10 million EBITDA companies that we tend to focus on. So I'm not sure that I felt like we've had that much direct competition with strategics, but there's kind of this umbrella of strategics buying things at high numbers so that even a small company thinks it's worth 10 times. There's a lot of expectation out there that kind of screws things up. And actually, just to go back to your question before about deal flow and what we've seen, I mean, I don't know exactly whether our indication of interest are down or not, but I know we've passed on a lot of good companies where we just thought there's no point because it's going to go for a multiple higher than we'll want to pay for it. So it's a little hard to.
True of us too.
So the quality, it's difficult to measure in that respect. It might have been a good company, but
Yeah.
it's not quite worth that much.
Quality is one of the hardest things to measure, but
The quality always has to be balanced with value. Always.
true.
Quality at 9 times is a little bit different than quality at 12 or 14.
Absolutely.
Well, I guess on the flip side of that last question, so if I'm hearing you correctly, strategics aren't really playing much of a different role than maybe they were historically, but
In our market. Now, Bob probably has a different answer, because if you're talking about $20 million EBITDA companies, I think it's a different story altogether.
And we'll go up to 300 million in enterprise value a couple times, but we're starting to see, when we ask the investment bank, well, who's bidding us? Well, we are showing to do some strategics. My next question facetiously is saying, well, how many weeks ago did you show it to them? Usually they'll say about a month, because they take a lot longer. So if there's time sensitivity, typically we may have some advantage to turn around, because there's many more layers for them to decide whether this is the right one. The smaller deals, I don't see the strategics. But I would say also, a lot of deals we're not even seen. Sometimes the investment banker says, this is definitely going to be a strategic. I know some pegs would like to look at it. I don't have enough bandwidth, or I'm just going to go to the strategics, because they're going to pay the highest price anyway. And I'll just bite the bullet and know it's going to take another month or two longer. But sometimes these strategics' due diligence is not as onerous as ours, because it's their world. It's a rounding error to some of their balance sheets. For us, it's not a rounding error. Every deal is not a rounding error. It's a major number in our transaction value.
So talking about, looking at the other side of the coin, private equity groups, are you seeing more competition, more involvement in deal processes than you did last year or over the last few years?
Look, if you just go back to the last 15 or 20 years, it gets a little bit more competitive every single year. There are more intermediaries, there's better information.
Market's more efficient.
There's no question the market's much more efficient. So the way we've responded is we've expanded how many dedicated business development people we have, because we know that we need a big funnel, because we're going to say no to a lot of good companies and processes because we think they're going to be too expensive, or we're going to get outbid for things, because again, at the end of the day, a good company still has to be at the right value. So that's really the only way we found to respond. We have a few different things we do in ways we like to turn over stones to find things, but yes, it's more and more competitive all the time.
If I could just add to that a little bit, we've seen strategic interest in deals that we're chasing. Almost every time there's one, the banker's at least telling us that there's one strategic party interested. I don't know if that's always the truth, but that's what we hear. And we've seen deals that we've chased and wanted and come in second place to a strategic. They tend to be at more the higher end of our scale, so 7 million of EBITDA and higher when we see a strategic come in. But what we have seen more of, I think partly to your question, in terms of PE competition, is in times like this, funds that typically focus on the larger end of the spectrum come down market. And if it's not outside of their range, then it's at the bottom of their range. And that kind of forces us we'll still compete there at the high end of our range, but yeah, we probably skew a little bit more to the lower end of our range as well. And that comes back around to the add-on story here, why you're doing add-ons. They tend to be smaller, they're at the smaller end of your scale range, and there is kind of a size premium that gets into the valuations.
That's an important phenomenon he mentioned, though. You do see larger private equity firms that have a lot of money. They've got to put it to work, moving down into areas where they previously didn't really play. So it's just everywhere. There's the different reasons for it to be becoming more competitive, but it really is almost everywhere.
At that point, are they basically playing the role of a strategic?
Well, it's not that they play the role of a strategic. It's just that it's just more. First of all, they're accustomed to paying higher multiples, so I think they probably pay more than it's kind of like we're looking around saying they're screwing up the market because they don't understand that it's supposed to be this valuation here. And then for strategics, one of the things I tell when we go through sale processes, I tell our management teams, if we're going to go to strategics and financial players, I say, the one thing I can absolutely guarantee about the process, I said, and that's the highest bid might come from a strategic. And then the lowest bid will always come from a strategic. I mean, that's not always true, but it is amazing. We're all running models, and this is what we do for a living. So at the end of the day, it's a pretty narrow band, really, that we all end up in. But the strategics, you never know how they're going to value something. They may have some reason why they can pay literally $100 million more than the next guy and be happy about it. But then other guys, I mean, the first business I ever sold was a business that had $5.5 million of EBITDA, and we got a $4 million bid from a strategic buyer because that was the book value.
Did you take it?
We reluctantly passed on that one.
I think this is a great transition to go to our next subject, which happens to be one that's near and dear to my heart. That's deal sourcing. So I think to kick off this segment, what I'd like to do is get each one of your perspectives, for your firm level perspective on deal sourcing. So specifically talk about how many deals you guys look at in a year, and then your approach to deal sourcing. So specifically things like, do you guys have dedicated deal sourcing personnel, or is it a shared responsibility, or something in between? Can I start with you, Bob?
Sure. The philosophy of Riverside has always been origination, deal sourcing is a key integral part of the firm. The second or third employee was a deal sourcing person. And the rationale before that, and it's always maintained, is that if you're chasing a deal and you're working on it, you don't have time to respond to the investment bankers. And whether you close that deal in 2 or 3 months or you lose it, you go back to the investment bankers and say, I'm back now. Can you show me some deals? And they're going to say, well, where were you when we kept calling you and sending you all these? You can do that 2 or 3 times, and then they just give up on you. And there goes your whole source of finding deals down the drain. So we have always maintained and improved on that over the years. And my predecessor was one of the first 3 employees. And now there's over 220 of us, and we have 13 people in North America focused on origination, not necessarily always on the front line, because we have some people doing the analytical work, we have some people tracking the deals, then we have 4 or 5 in Europe, plus the back office support. A little bit lighter in Asia with 2 to 3 people, there where everybody wears multiple hats. But it has been a theme within our firm. You have one point of contact as an investment banker, and we will figure out what fund and where to place it, and we'll keep you involved at all points. And hopefully that makes it easier for them. It certainly makes it easier for us.
Quick sidebar question. Is there a difference between your approach to deal sourcing and the process in North America versus some of these other regions that you guys are active in that you just mentioned?
It's different only in the fact that we in North America have 3 funds that we have to provide service to. But for the investment banker, it's very simple. I don't know which fund to send it to, but I'm just going to send it to you. You sort it out. And that makes their life very easy, whether it's a minority investment or it's a smaller investment or a larger investment within our 3 funds. In Europe, somewhat similar. They're in 3 different countries, our colleagues in Scandinavia, in London, in Brussels, in Munich, and in Eastern Europe. So they're scattered a little bit further away, and of course you've got multiple languages, so it makes it even more important, I think, to have somebody that speaks the language. Obviously the fallback is English, but the communication just isn't as strong there. Then in Asia you've got the same thing with multiple languages. So it's a little bit easier in the United States, but we have more deals. Our total deals we looked at last year are around 4,200 globally, and we reviewed somewhere around 792 at our Monday morning meetings around the world. And if you take it with the waterfall all the way down, it wound up with 40 acquisitions last year, 20 platform and 20 add-on.
Yeah, so going back to the original question on dedicated deal sourcing, I mean, I am the dedicated deal sourcing resource at High Road. We're a much smaller scale than Riverside, but ironically, we spun out of Riverside, and our managing partner was part of that original team that had deal sourcing as a critical component to what they do, and thankfully for me, that was the same approach that they took when they started High Road. I was the first employee brought on board at High Road in 2007, and it's been a focus of mine. It's been a focus of our firm. It's considered the lifeblood of what we do. All the things that Bob said about the philosophy around needing somebody on target with intermediaries and other deal sources, and it's a lot more than just intermediaries now that you manage as a deal sourcing person. There's intermediaries, there's direct sourcing, there's alternative sources that are like accountants and lawyers, and it's even more so that way in Canada and places like Canada. There's just a lot of things to think about in a deal sourcing seat and among the deal sourcing team. So more and more you're seeing funds adding dedicated resources to manage all that, and High Road is one of them. I know Clearview is one of those too.
Yeah, we have always had a dedicated facility for deal sourcing. In fact, one of our first 3 founders was also dedicated to deal sourcing, and we've now expanded that team to 4 people who source deals out in the field. Plus, we have some back office assistance with that. So we believe the dedicated deal sourcing is important, and you're right. There are a lot of different ways. We talk to bankers, and I like to say there's everything from professional bankers all the way to the guy and his dog working out of his basement. Because you do have that in the lower middle market. You have guys who are aware of a deal, they want to bring it to somebody. We need to know all those people. You drill a lot of dry holes with those guys, but every now and again you find a gem. And I think you need to cover the world to really dig up enough deals. I mean, we reviewed in the top of the funnel about 1,200 deals over the last 12 months. That gets cut down very quickly. A lot of them don't make the Monday meeting, as Bob mentioned. But I think we're probably very similar in our thinking that you have to have a lot to choose from to get the good ones.
Yeah, I think if you go back, I joined Riverside 13 years ago, and there were a core group of maybe 10, 12 PE firms that had dedicated deal sourcing. And if you go to a source like Sutton Place Strategies, where Nadeem is there, and he tries to sell his services to all of us and does a good job, there's at least 130, 140 PE firms now, and maybe more that have somebody with almost 50%, 80% of their time doing it. So the question is, when you're out raising money, the limit is now asking you, how do you source your deals? If you don't have deal sourcing, why don't you? And justify it to us. And now with the SEC saying, how do you allocate deals, it just sort of raises that to a different level of scrutiny, not only internally and externally from the people providing the funds, but also the regulatory agencies. They're trying to figure out, well, where do you put the deals? And if you're from one fund and you source a deal and it comes to another fund, how does that work? So that raises some very interesting issues as well.
How are these dedicated teams spending their time, outbound versus inbound? Is there a standard allocation? I assume predominantly outbound.
Well, there are targets that we have to try to meet and make sure that we are reaching out to people. We have methodologies that help us make sure that if we haven't heard from a banker or they haven't heard from us, or I shouldn't just say banker, a deal source, it typically is a banker, but that we make sure we cycle back and do reach out to those people if they haven't sent us something in some defined period of time. So it's hard to say how much time is spent in any one area. There certainly is some portion of time that is meant to be outward focused. But the more you do this and the longer we've been in the market, more deals come to us. And then you have to spend some amount of time managing that. And again, with all the different ways that deals can come into you these days, it could be a significant amount of time. And that's where you're starting to see, I think, deal teams or deal sourcing teams like ours that is very small at the moment starting to build out a little more infrastructure.
Okay, well that's a good transition to the next question. So how has deal sourcing changed over the last few years? And specifically, what role is technology playing in deal sourcing? Things like online deal sourcing and maybe some of these other approaches and processes that you're talking about that give you guys a competitive advantage.
Well, I'll speak for us. I mean, when we started, we had an ACT database and an Access database, and we tracked these things. And from the beginning, we really wanted to be able to track deal statistics so we could understand where we were being successful and where we weren't. But parallel databases, not really set up for that, trying to do internal programs. So we flipped over to Salesforce several years ago and have built out our own customized Salesforce database that allows us to track all our deals, all our deal sources. It's a really good tool, but it took us, well, I wouldn't say it's not even really done. I mean, we continue to invest in it to try to make it a better resource. But how have things changed? I mean, I think we've gotten better at what we do. We're a little more targeted than we were in the past. We have more feet on the street. And certainly in terms of add-ons, we're much better focused, knowing exactly what we want to go after, and then plumbing our database to try to go find those specific deals.
Yeah, I would second the comment on CRMs. Starting in this position in 2007 with High Road and doing the same thing with an ACT and Excel, combo of trying to track things, it would have been impossible to manage the number of relationships and manage the number of deals that we look at and try to provide timely feedback on and do all the things that you need to do as a deal sourcer without having, first of all, a very organized approach, a disciplined approach, but having a way to track and measure all that. Beyond that, where else is technology kind of impacting deal sourcing? Platforms like Deal Nexus and Axial Markets. As a deal sourcing person, that's something that helps make everyone else more efficient, so I'm not always in love with those platforms, sorry. but I recognize that they are going to be a part of the market, and we use them. We view it as, at a minimum, a safety net, and in a very positive way, a potential source of new platforms. And really, where I really see the benefit of the online platforms is through add-ons. You can put in a profile of all your platform companies in these deal aggregators, and if it works properly, the characteristics of what you're looking for add-ons should match up with characteristics of deals that are being put on the platform, and that should help you see a lot more opportunities for add-ons especially.
Yeah, we're on our third generation now of software, starting when I came with an antiquated system, and we upgraded to ACT, and then we went to another system, and about 5 years ago we brought on Deal Dynamo, which is a software system out of Eastern Europe, and now it's integrated across the entire firm. Our IR uses it. It tracks notes, it tracks memos, anything that's written gets put in there. It allows us to, quite frankly, track just about everything we do. As the old adage goes, expect what you inspect, and if you're not tracking deals, how do you inspect what you're doing? How do you inspect what the people are doing? And then how do you measure yourself if you're not measuring yourself in terms of which firms are bringing us opportunities, which firms are focused on certain industries compared to others. So we know if we're looking for something in consumer products, we might actually reach out to a few investment banks and say, we're looking for add-ons in this area and here's why, as opposed to just hoping they bring them to us, because it's a two-way street in terms of communication. We're starting to segment some of the investment banks in terms of areas that we want to really focus on, and how many times are we contacting them? Are we doing it the right way? Are we tracking deals we turn down? And then we look at some of the deals we turn down 6 months from now and say, ouch, or boy, I'm sure glad I missed it. But it's just as good to color what I call deals done away, and we publish it every month. Sometimes it just tracks who bought the deals, and that's important to know who our competition is, because that changes. It's important to know, well, it hurts to see the ones we color green, because we say, gosh, why didn't we bid on that, and what were we thinking? So you constantly have to reflect and say, what do we do in our decision-making process? And then there's those, when they're red.
We've all had those.
And those are the ones that really make you feel good. I mean, you feel sorry for the poor other PE firm or other buyer, but it helps you to figure out, okay, that's part of our decision-making process. Let's instill that and make sure we do that again and again. When something doesn't look right and you pass on it, you always have that remorse. There's I wish I had put a higher bid to get that, but then sometimes that's confirmed when that company comes up red on your little sheet. So it has evolved. We're using the software systems a lot more. To Rich's point, some of these other services that are providing, we use that as sort of a back check as well. I didn't know that investment bank was out there. Maybe I should talk to them. So it does help.
Yep.
All right, we have one more question in the deal sourcing segment, then we're going to move on to some of the recent deal activity you guys have been involved with. So if you could sum up in just a handful of sentences, what trends are going to shape the future of deal sourcing? Could you give me the quick view from your perspective?
Well, I mean, the trend that's been happening and has continued to happen is more and more firms are going to add dedicated deal sourcing. I don't see how it's going to stop. It makes too much sense, especially the smaller the markets, the focus, the more important I think it is to do, and also the broader the focus of the firm. We're opportunistic, we're generalists, so firms like us, I think it's critical to have somebody be there in a dedicated way in deal sourcing. You may not see that as much with firms that have more of a laser focus on a particular industry, and the team that's in place knows who the sources are. But I think it just makes sense, and LPs are looking for it, and as Bob has said a couple of times during this discussion, that's going to drive people to act. You guys got to...
I see two trends. One, I think you're going to see a lot more firms, PE firms, adapting some hybrid, or they're definitely going to go all out and hire somebody like Rich or myself for on origination. I think also you're going to see going forward some of the PE firms like ourselves. Each one of the people on my team has an industry focus, so they're not going to just in their own specific general area, bring in deals. It's going to be industry focused. And then finally, we're starting to use a new technology. I think it's really working well. We're using the telephone.
It's an amazing thing, isn't it?
It's an amazing thing how you develop a relationship when you call somebody instead of sending them an email, or worse, when you get 10 emails from people you have no idea and they just say, I'd like to talk to you. And that's fine, but once in a while, a phone call, I respond to those immediately. When you get 200 emails a day and most of them are quasi-spam, I mean, some of them are great market data, you have to sort through all of them. A phone call, I respond immediately to. It's an amazing thing about that, Alexander Graham Bell.
Yeah, but I've heard that the analyst and associate classes are having difficulties adopting that technology.
I don't disagree.
I think you're absolutely right about that.
You're right.
And some of us are having it on the other side using the IT sides. So, but relationships still, when you have to send out a book and they say send out to only 10 PE firms, who are you going to send it to? The people that stick in your mind, and it's not from an email.
Mm-hmm. Yeah, I like that. I like the idea of bringing the phone back. All right, quick reminder to the audience, if you have any questions you would like to run by our distinguished panel, you can do so by submitting it online, and they will feed those questions to us here in the studio. Let's move on to one of the final segments of the discussion. I want to talk about some recent deals you guys have been involved in as of late. Jim, I want to start with you. Clearview recently announced that it's seeking add-ons for Northwest Cosmetic Laboratories. Can you tell us about that investment and your plans for continuing to grow that business?
Sure. Northwest Cosmetics is a formulator manufacturer primarily of liquid cosmetic products. They're based in Idaho Falls, so that's a strong nexus on the West Coast. They're a very, very rapid organic growing company, but our customers are demanding that we add capabilities. They really like what we do, and they think we'd do a great job in something like powder or pressed powder. So we are in search of add-ons that bring us that capability, or others that would help us round out the kinds of products that we can make. In addition, it would be really nice for us to have a nexus on the East Coast. We do have East Coast customers that we serve very well, but there's something to being close to your customers as well. So we're looking for both of those things, and we have already reviewed a number of potential add-on acquisitions and have a couple in process, which is good, but we certainly want more. It's a great platform, terrific management team. We've upgraded the IT systems like we talked about before, so we're ready to go.
Excellent. All right, Rich, York Wall Coverings. Tell us about the growth opportunities you're seeing for that company.
Yeah, York Wall Coverings is was an old family-owned business out in York, Pennsylvania. They focus on what they say they are, wall coverings products. That includes wallpaper, moldings, and a cool product, peel and stick, that kids put up on their walls typically. Like Fathead, they would be a competitor. Ours would focus more on licenses, like from Frozen, for example. So that in itself is a growth area. We like the building products market, generally speaking, right now. This would be a very niche area within that. Believe it or not, wallpaper is in vogue and has had a nice growth history in recent years, and we think there's a lot more room to grow there. But beyond that, we're trying not to limit them in terms of what we're going to focus on for add-ons. They've got a great distribution network. We think there's other things that could be sold through the distribution network beyond wall covering type products. So we're casting the net sort of broad right now and considering lots of different product categories. Geographic expansion is another way that we would look to expand and grow the business. We're pretty excited about it.
Great. All right, so Bob, among the transactions that Riverside announced this year was an investment in Greenfire, which sits at the intersection of two of Riverside's most active specializations, software and healthcare. Can you tell us about the investment and Riverside's growth plans for the company?
Yeah, this was a very unique and somewhat atypical acquisition for Riverside. Greenfire is in the cloud-based and clinical payment management and data analytical solutions. That's a lot of words. So to break it down, what it does in the clinical trial situation, particularly for the pharmaceuticals, the CROs, hospitals, where you have patients that are part of a trials and they get paid for that, You've got several management issues there. When did they show up? What was the contract to pay them? How much do you pay them? How many times do you pay them? And then you get the payor saying, I need to track this because there's opportunities for mistakes, errors, fraud. How do I manage a payment system? In the old days, it was done on an Excel spreadsheet, and it was done by writing a check. Now it's broken down into two systems, what they call the B2B and the B2C. The B2C is what they call the CLIN card. The patient will get a card, just like a credit card, and every time they show up, money is loaded onto that card. So the payment system is very easy. You don't have all the bills and the pays and the payroll. Then you have what you call the eClinical GPS. That's the management system that tracks this. It shows how many patients were paid, how many days, where around the country, what was the application, what were the outcomes on that. So it's a whole tracking system, and it's SaaS-based. The growth in that is phenomenal because everybody's saying, gee, where were you 5 years ago, 10 years ago? Because you got the regulatory issues, you got all the government agencies that are hiring people to do this as well. We've doubled our sales force in the past year. And we're also looking at overseas, and I say everybody goes overseas. A lot of these clinical trials are in fact overseas. So the payment system, that's the B2C. We're now expanding that, particularly in the CRO side, and we're doing it in very difficult countries like Russia, where there's a lot of payments as well. We're doing it in some of the Eastern European countries, in Asia. So that's one way, and when you go international. The other side of it, I think, is a little bit more difficult is the management of that information because you've got multiple payment systems. There's something like 46 different countries that you're paying into, but it starts to track that as well. So we're pretty excited about this. When we bought the company, it had all the aspects of a venture capital. Our typical growth for our microcap fund, the 1 to 7 million, is somewhere to 20 to 30% growth. This was significantly higher than that, and I'll just leave it at that. But it had the risk profile not of a VC. We in PE get upset if we lose 1 out of 10. In VC, if they win 1 out of 10, they're pretty happy, and that's huge. So this has all the upside of a VC with a much smaller risk profile, and so we're pretty excited about that.
Outstanding.
But that was the end of last year, so stay tuned.
Congrats to all three of you. All right, one more open-ended question for the group, and then we do have some questions that got sent in over the wire from our audience out there watching. So, final question of the agenda is 2015, and specifically, what are the key themes in private equity we're going to see for the remainder of this year?
Well, things are still hot. I mean, it's expensive. You know, I don't see a major change from what's happened over the last year.
Yeah, I think it's going to be more of the same. You might see interest rates tick up a little bit here, but I don't think that's going to really impact activity levels. I think that valuation multiples are still going to be high where they are. It should force us to continue to look internally as well at our own portfolios and figure out, you know, what are the right exit opportunities at this time. And then just in terms of sectors, you know, I think healthcare is going to continue to probably be an attractive place because of all the change that's happening there, and there's ways to try to take advantage of that. It also makes it a little scary, but if you can figure it out, I think it's a place to be. And the same could be said about oil and gas, I think, or energy broadly. I think there are going to be opportunities there, but again, that could be scary as well. And I think B2B has been also, you know, an area that's been hot, and I think it's going to continue to be.
To echo the same theme, multiples are exceptionally high, and you need to have a strategy. How do you address that? Because the vintage of 2014, 2015, 5 years from now, could be a make or break for some PE firms if we don't get it right. So what's your strategy? As I said, we have sort of a barbell, fixable flaws, or it's exceptional and there's something we can do about this, but we are modeling it at a much lower side. Industry-wise, healthcare still is going to be very, very strong. I think we've seen a lot of manufacturing coming back to the United States, and that's becoming sort of a positive theme. People are getting excited about that. Energy in the right places, if you can figure out what's going to be sustainable. I mean, oil's not going to stay at $46 to $50 a barrel forever, but there's going to be a big shakeout at the end of this year if it doesn't get up to 60, and I don't think it will. The other theme is really competition. And that for many of us in the PE world, the final theme is the whole regulatory environment. There's a lot of things that the SEC has to do, mandated by Congress, but they haven't quite figured out exactly what the right rules are, and there's a lot of misinterpretation. I sometimes say it's like going to the TSA. You go to different airports and you get different directions, and the SEC, those that are doing these visits, they all have different thoughts as to what to reinterpret the rules. That's what ACG and some of the other lobby, ACG is not a lobby, it's more of an organization, is trying to educate Congress. It's not the SEC, they get it, but we have to make sure that Congress understands the regulatory environment. Some of those rules were the, what are the unintended, the consequences of unintended good. Sometimes we're hammered for things that we're not responsible for. And that, I think, is some of the issues we're trying to get those things changed.
No global entry for private equity, huh?
No global entry for private equity.
All right, we're getting close to the top of the hour. We have a couple of questions that came in from the audience, so why don't we see how many we can get through. Question 1, how do you evaluate sectors that are good platform plays? When creating a new platform, how much insight do you usually have to the number of add-ons that are potentially possible? And I'll let anybody step in on that first.
And we love fragmented industries. So we usually have an idea that there are lots to do. You can't always get your arms around every one. Go back to my adult daycare example. Yeah, we know there's 4,600 adult daycare centers in the country, but most industries aren't so easily quantified like that. But typically we're going to like industries where we have a sizable platform but lots of small add-ons to do. And we're not generally going to go into a situation where we don't think we can do a whole bunch of small add-ons.
Yeah, I don't have much more to add to that. I think our approach is similar. Buying a good, solid platform that's got a leading position within a fragmented market, I think, would be an attractive investment for us. Sometimes we do, a lot more research behind an industry if we're not that familiar with it, but there's something to it that seems, just on an intuitive level, it seems interesting, and there's ways to do that independently, or to go out and hire somebody to help you do that research. But generally speaking, we have a pretty good sense. We look at a lot of deals across a lot of sectors, and we generally have a pretty good idea of, what's going to be a good platform, and then from there, what the add-on story is going to be like.
Yeah, I think for us, when we find a platform, part of our discussion at our investment committee is what are the add-on opportunities. And if it's fragmented, but you think your company, typically we look at what we say little leaders, then we have a category less than little leaders, but the strong potential through add-ons and through changing some of these fixable clauses to make it a leader, that's key to our strategy. We have to say in our own minds, how do we make that number one, number two? Sort of the GE model, sometimes they're 3 or 4. And if you can see enough add-ons in there, you can see within the fog of battle a clear path to making that a premier company.
Question 2, how does geography play into considering potential add-ons?
Well, I think there's, in a couple of ways. You have some companies that really are regional plays, where you're trying to consolidate in a region. We have, for example, our Pyramid Healthcare business, which right now is one of the largest behavioral health companies in the New Jersey, Pennsylvania area. We've done several add-on acquisitions in footprint. We've considered acquisitions in other parts of the country, but you have to consider how is your company and management team capable of reaching across geographies over distance to really manage something appropriately. We've been fortunate. We've had plenty to do right in our region that was in our wheelhouse. And then there are other circumstances, go back to Northwest Cosmetics Labs, where we'd like to have an East Coast presence, where being in a new geography is one of our goals, where we think it'll be really additive. I mean, broadly speaking, I see it as 2 different kinds of situations depending upon the company.
Yeah, I think it's the same for us. It's one of those answers. It depends. Some of your businesses that you get into are, by necessity going to be probably more regionally focused and oriented than others. And we've had examples of both of those. We've had a Canadian business that really needed to be in the U.S., and we helped them do that in a big way. And then we've got another Canadian business that really is probably better suited to stay Canadian. It depends on, I think, the investment.
If we're looking at some platforms and it's susceptible to certain regulatory issues and state and local, then we're looking for some diversification. You don't want to be saddled with one particular state, particularly if they have funding issues. There's some states in the United States that you probably wouldn't want to put your money on their bonds unless you were in the venture capital. So you want to make certain you've got a diversification there. But If it's an industry that's growth, we're willing to live with an industry, with a regional play, as long as we can figure out how to have a growth strategy and build out around it, to go to Jim's point. If it's in the Pennsylvania area, I'm not certain our next add-on would be in California. We would try to round out so there's a critical synergy between, and for management control, span of control over 3,000 miles is pretty tough.
Well, it looks like we're all out of time. Gentlemen, thank you so much for joining us today, for the lively discussion, for the insights. To our audience out there, thank you very much for watching. Have a great rest of the day.
Thank you. Thank you.
Thanks very much.